In this video, you're going to learn everything you need to know about put selling so you can use it to generate monthly income and do so safely. Again, you'll see exactly how I did this for myself. Here's a screenshot from my broker. I made about $1,400 using only $5,000 in a matter of 3 months. I mean, I made a 30% return on my money in just 3 months. But not only have I done it for myself, here's a back test to show you that, hey, long term, this works over the last 10 years, which we'll be diving into further. And then also I've helped over, well, now 600 people do this as well. Here's what you'll be learning on this training. You'll be learning why you should be trading the put selling strategy, how to structure the put selling strategy, how to manage it, how to actually understand the risk and how to mitigate it with account sizing and scaling rules, how I personally traded the strategy that I actually follow, and hopefully I can get my face out of the way here, make it smaller just so it doesn't take up too much of the screen. And then also, I'll be walking you through how to trade it in different markets. What if the market is bullish? What if it's bearish? What if it's neutral? How do I trade it? I'll show you each one of those in examples. I'll show you the advantages and disadvantages so you know what's amazing about it and what to look out for and how to plan for that. I'll show you a real trading example. We'll dive into the chart. We'll dive into my broker. I'll actually show you how I pick these strike prices, how I pick the options, what I look for, so that by the time you're done with this video, you will be able to walk away knowing exactly how to implement this strategy to make monthly income, but do so very safely so that you can rely on it for retirement or to grow your account. I'll also show you as a bonus how to automate the exact strategy so you can actually do all of this that I'm about to teach you either by hand or get your time back as well. So here's a legal disclaimer that I must share before we get into it. This is for educational and entertainment purposes only. Trading is risky and 99% of people will lose money. Past performance, whether it's mine, somebody else's that I show, or a backtest that I show, does not guarantee future results. So do not bet the house, your retirement, or your dog's college fund. Also, trading is 100% your responsibility. So if something goes south, it's not my fault. All right, that's sweet. Now, why should we trade the put selling strategy? Why put selling? Okay. It's a simple mechanical trade. If you ever like, oh my gosh, I have to find a new stock every morning, I don't know what to do, all these things, like it's a new setup every day and it's something new. That's not how trading should be, okay? You should go into the same asset every day and you should be doing the same trade. And that's what breeds consistency and that's what leads to results. And so this is a simple mechanical trade where every single week you'll do the exact same thing. You don't need to understand chart reading. You don't need to be an expert at knowing support and resistance or anything like that. You can easily scale this, whether you have a small account now, maybe 5,000 or so, or you have a $100,000 plus account. I'll show you exactly how you can scale with this strategy. It has a very high win rate, 95% or higher. So if you're looking for something very consistent, this is that. There's no risk to the upside. A lot of strategies cap your upside risk, but now you have that upside profit, and there are multiple ways to enter and exit this trade to ensure that you make money. Now that we know all that, how do we actually structure this trade? How do we put it on? What strike prices do we look for in all these things? First off, we need to understand the goal of this trade. The trade goal for this is passive income from data decay and bullish markets, okay? So you're ideally looking to make money from time passing and from the market in general moving forward or moving higher. And so how do we structure this trade? We look for an expiration date that's 90 days out. Again, this is what the average type of person does, 45 to 90 days. Strike selection tends to be a one standard deviation trade. So this means a 16 delta put is what you're selling that on. Your target credit, you're looking to receive about $20 to $40. Again, this depends on the asset you're trading as well. This is based on SPX or a futures contract. You're looking for around $20 to $40. Now, your ideal assets to trade this on are going to be futures because you get the better leverage, which you'll see when I dive into the broker section. But again, those symbols would be ES, GC, CL. And then again, if you're not going to do futures, SPY or SPX are great options as well. Now that we know how to structure the put, how do we actually manage it? And now you'll be like, Austin, you're moving a little too fast. Don't worry. I'll do a whiteboard screen share soon, and I'll break down everything more in depth. Okay. So the take profit rules are 50%. So since we had a 50% return on our trade, we will close it out. Stop loss rules can vary between the 200 to 300%, depending on how much risk you want to take. And then early management rules, if you want to set those, are around 21 DTE. Now, what are the three biggest risks when using the put selling strategy? Okay, number one is market risk. Okay, if the market were to crash or go down dramatically, go down quickly, we will see massive losses as a put seller. That's something you need to know, right? Because this is an undefined risk trade, we could have unlimited losses. If the market quickly goes against us, we will see a lot of losses. And so again, that's the definition of undefined risk. And so the solution here is we can use indicators to warn us about high risk markets and when to stay out and when to adjust our sizing. And again, I'll be walking you through that in just a second. I'll take you to a chart and I'll show you a very simple free indicator that will warn you about crashes before they happen. Risk number 2 is manipulation risk. So the problem here is if you've ever traded options for any amount of time, you know this to be true, right? If you do a stop loss or a limit order, this can lead to losses due to market makers manipulating the options price. So what I mean by this is when you put an order that just sits out there in the market because you're waiting for it to get filled in the future, whether it be a stop loss or a limit order, when that order sits out on the market, anybody can see it. And so market makers, hedge funds, and algo firms, and all these people will check out those orders, manipulate the options price to get your order to trigger early, and they will take advantage of your order and you'll have a loss for no reason. And so that happens all the time in the options market because it's less liquid than the stock market. And so that's what you'll see a lot. So if you've ever had a stop loss or a limit order trigger early for no reason, that was why. Now, what's the solution? We can only submit an order, whether entry or exiting, whatever, when we're ready to do that thing. So if we're ready to enter, then we'll submit a limit order at the mid price. When we're ready to exit, then we'll submit a limit order at the mid price for exiting. And so again, only entering the order when you want, which is something else that we could solve with automation as well. And I'll show you that towards the very end of the video. We have risk number 3, which is volatility risk. So the problem is, as option seller, which is put selling is, we're selling a put contract. I'll explain more about this here in a second. If volatility goes up, we are going to lose a lot of money. We are going to have more risk. We're going to lose. And so if VIX spikes all of a sudden, we'll see a huge and sudden losses. And so again, how we protect against this is we adjust our buying power usage based on where VIX is, okay? So when VIX is lower, option sellers, we have more risk. So we'll be in less trades, right? If VIX is higher, we have less risk and higher win rates, so we should be in more trades. When VIX is lower, we'll be in less trades. When VIX is higher, we'll be in more trades. And that's how we can adjust it. Now, how does this come down to account sizing and account scaling, okay? So when it comes to account sizing, again, there's a thing called the 30% rule, which is that you should have no more than 30% of your account in trades, okay? So if you have a $100,000 account for reference, then only $30,000 should be actively in trades. And so that's how we look at it. And so again, that can vary. If you have a $5,000 account, then you want no more than 150 in trades. So just understanding what that risk level is with your account and how much should be in trades. Now, how do we scale this trade? Okay, if you have less than a $10,000 account, you should be doing this trade once a week on MES. Why? Because this is the most buying power efficient, small account asset you can use. Now, is this the best asset to trade? Absolutely not. The bid to ask spread is quite large and volume is quite low. But if you have a small account, this is the only thing you can do. Now, if you saw my broker screenshot that I shared earlier, I was actually doing my own put selling on MES for my smaller accounts. I was doing it and it is working. It will just be a bit more difficult with the low volume. If you have a $10,000 to $25,000 account, you'll be doing a trade once a week on ES. So you'll get to move up to a more liquid asset, something that you should be trading this on. And you can do so on a weekly basis, depending, again, on the asset and account size. If you're around $25,000 to $100,000, you can do this trade twice a week on ES. And then if you're $100,000 plus, you can do this trade twice a week. So Tuesday and Thursday, so that is split up throughout the week on ES, and then from there, you'll slowly start to scale your contract sizing. So you'll still do twice a week, but instead of doing one contract you sell each time, you'll do two contracts you sell, then 3, then 4, and size up as your account allows based on the 30% rule. So all those details were best practices around this strategy. Now I'm going to share how I personally trade this and why I do that. Again, my goal is the same goal, again, to generate reliable monthly income, but with as little risk as possible. It looks like I brought that in there, so I apologize for that. Days until expiration, okay? So on average, most people go 45 to 90 DTE. I go out to 120. And so you might be wondering, why go out so far in the future? Because the further out in time you go, the more time you have to be right on the trade. And because you have more time to be right, the volatility risk is a lot lower. So by going out further, I lower my risk as a trader. Number two, I also increase my win rate. Why? Because the further out I go, the further my strikes are from where the stock is trading, my current level that I'm betting on. It's further away. So I have a higher win rate. And also third, with that, I get to collect more profit. So the further out I go, I have less volatility risk, I have more profit that I make, and I have a higher win rate. So that's why I do 120 DTE. Strike selection. Again, I do a 10 delta put. Okay, instead of doing 16 delta on it and coming up a bit closer, what I like to do is 10 delta. I like to go a bit further out, but still collect enough credit. So not a 5 delta, but more around a 10 delta is what I like. And you'll see the backtest behind this soon. My target credit per trade is to get around $30 to $50. So that's around the amount of credit that I'm trying to collect on these. Again, I'm doing this on MES and ES. And so that's the credit target that I'm basing it off of. My take profit is not at 25%. Now you may be wondering, okay, this is a smaller take profit. Why only at 25%? This allows my trades to turn over faster, okay? So another point of risk is that if you put on a trade once a week and the trade takes a month to close, now you have 4 trades open that are all at a risky point that can all lose, and each one can lose you a few thousand each. But if you do a tighter take profit, like 25%, now the trade only goes on for 2 weeks. So now I only have 2 open trades running at a time. So I have half of the risk out there, meaning that if the market were to do something bad, I'm only going to lose on 2 trades instead of 4 trades like before. So I'm able to close my trades faster and have less money out there for something bad to happen with. Now, early management is 21 days. Why do I do this? Because VIX spikes can automatically knock me out of positions if I have a set stop loss. And so what I do is I just allow plenty of money so that if something goes wrong, I have that money to withstand those losses in the short term. And then I just let the trade play out. And then I close it at 21 days to help offset extra volatility or movement risk. Again, my main assets are futures options. They trade best on futures options. You'll see why when we go to the broker section here in a second. But ES and MES are going to be the best ones for that. Here's the back test of mine. And so I'd be saying, Austin, that looks really good, but I do want to pinpoint some of the issues here. Okay. So if we look at the original back test that I showed you, this is based on best practices and what the average person does for their put selling. You can see here, in general, does pretty well. Risk across the board is pretty standard. Minus 10% is the lows that you see here with your max drawdowns. If you see here, though, we do see a lot of shaky movement. We see a lot of up down. And so you won't see that with mine. It just looks like one smooth curve. Again, the reason for this is we're going out further out in time, 120 DTE. We're pushing our strike prices further with a 10 delta. And then again, we're not closing a trade when a stop loss level is hit. We're just holding through the trade. And so that helps give us this very smooth curve, which all is about a 99% win rate. But where's the issue with this? Because there's always an issue. There's no free lunch in the market. And that is this. Max drawdown risk is incredible. Remember I said the max drawdown risk for the original was around a 10%? You can see here around 30% is what the max drawdown was in 2020 when the market absolutely crashed due to the pandemic. And that's what we're seeing there. And so how do we mitigate against this? We adjust our trade sizing based on VIX, which I'll explain further in a second. We can also use indicators to get us out of the market before this happens. We'll show you here in a second. Or a guaranteed way to make it through this, or a way to really help protect against this, is to have plenty of money set aside. This is why we use the 30% rule. That means 70% of our money will be sitting in cash. And since it's sitting in cash, we have enough money to withstand a huge drawdown like this because we have cash in our account to do that. And then the market's going to reset and then it's going to be fine. We just have to let volatility play itself out. And so that's what you see here. So be aware, the max drawdown risk is massive compared to the normal one. But when we're able to hold through it, we get better performance over time. You can see here, average days in trade is about 2 weeks. And so again, that's why I'm able to turn over these positions quite quickly, which is great. So the original practice. Okay. Now that you know how best practice is, how I do it, again, you can make your own decision and thoughts around what you should do. But regardless, here's how you structure the put selling strategy in different markets. Okay. If you're in a bullish market, this means higher highs and higher lows. The market is trending higher. Then what you want to do is you want to follow the ideal trade setup. Again, put selling strategies work best when the market is trending up. So this is when you will see your best profit and your fastest profit. It means your trades will be closing the fastest. Now, if we're in a bearish market, the opposite of what works best for this, again, bear markets are defined by lower lows and lower highs, so the market's moving down. In that instance, consider staying out of the market. I have no problem getting out of trade and staying out until the market resets. I'll show you a real example of this here when I pull up my chart, but that's what you should do in bearish market. And sideways markets, again, this means you're staying between the same high and same low, or same support and same resistance. It's just bouncing back and forth, up and down. If we have that type of market, again, just follow the normal setup that you do. This is where theta decay will do wonders. Again, the market's doing nothing, but as time goes on, you make money. That's why option selling is great. Now, what are some advantages of put selling? It generates consistent income. It's very easy to set up. It's just one contract, one option. It requires very little, if any, adjustments. There's nothing you really need to do, right? You just put it on and then you let it work. It can be stacked for continuous income, meaning that you can do it once a week and now you have 4 trades all making money at the same time. And again, there's all kinds of ways to play it. You can change the delta, you can change the expiration, change the underlyings, things like that. Plus, it's a good way to buy a stock at a discount if you're trying to do that way, which would be more trading a put selling on a stock or something where you want to be assigned shares. Now, disadvantages is you have the potential for very large losses. As mentioned before, if VIX spikes, if market crashes, you have a lot of risk, which I'll help you mitigate here in a second. But it can also be complicated if you're new to options, because you do have to have the right broker, pick the right strike prices and things like that, because if you don't, then you could lose money. It requires strict buying power management, meaning that you need to be aware of how much money you're using in trades, how much you have available, and making sure you keep those within the right limits. If you want to be safer, it requires hedging. So you want to hedge your trades, which that will cost extra money. There's uncapped downside risk. It's an undefined trade. And there's assignment risk if you don't trade it on futures, right? So if you're trading it on something like a stock, again, you can be assigned shares, which could be costly as well. Let's look at a real trade example. I'm going to share my screen. We're going to go to the whiteboard, break this down further, go to the broker, and then look at a risk profile. So if I'm going to the whiteboard, let's break down exactly all the details I just said with an image to help you understand it better, okay? Let's say this is a stock that's trading, okay? So let's say the stock is trading here. Okay, I'm going to sell a put, which basically means I'm going to bet that the stock will stay above a certain level. So maybe that level's way down here. I'm betting here. I'm selling a put here. This means I bet the stock will stay above this level. If it does, I make money. That's all selling puts are. So if the market goes up, I make money. If the market goes sideways, I make money. If the market goes down, but stays above my level, I make money. The only time I lose money is when it breaks down and breaks below my level. So again, unlike a stock where I only make money when it goes up, and I lose money when it goes down, in this instance, I have way more ways to make money, because it can go up and I make money, it can go sideways and they can go down and I'll still make money. And so this is why put selling, as you saw, has a really high win rate by default, and like a 90%. And then again, we can make those adjustments that I showed you that I make for my strategy that pushes it closer to 99%, which is quite incredible. Okay. So again, that's what the put selling strategy is. You're betting that the stock will stay above a certain level. And so again, that's how we do it. So let's say we get to enter in at a $20 credit. So we sell a put way down here and we receive $20 to put this trade on. Now, if we're doing a 25% take profit, that means that we're going to close the trade once the new trade price is, let's see what's the best way to do this. It's going to be $15, I think, if I'm doing my mental math right. $15. So once the new trade price goes to $15, meaning that it went from 20 to 15, so we made $5 from 25%, then that means that we're going to close the trade, okay? Now, we have no stop loss on this trade, so we're just going to let time play out. So again, time is just going to do its thing and play out, and we're going to make sure we have plenty of money to hold in those points of downside. But this is how it is structured, and this is how the trade works. Super simple, sell an option at a really far level, let time play out, and take profit at 25%. How does this look like in the broker? Let me show you. So here's the broker. Let's walk through it together. This is tastytrade. It's my favorite broker, but you can use any one you want as long as you have option selling approval with the broker. Okay. So we click on the symbol here. Again, we'll go to ES. This is a super liquid symbol to trade. I'll also show you an example with SPY so that you can see the differences between futures and stock, because there is a difference. What we'll do is we go to trade. We'll find this options chain, which is what it's called. which shows us all the expiration dates and the strike prices. So if we look here, like I mentioned, I go for 120 days out. So that means I look at the strike prices, which is this middle column, and I look for ones that closest to 120 day or 120D. So if I scroll down, you can see here we have 129. This is going to be the closest right here, or 130, I should say, because it's AM contract. And don't do AM, just do normal. So 120, the closest to it will be this one right here, which is going to be the 130. So I'm going to click into this. The right side are my put contracts. I'm going to make sure that I see delta here. So delta, I'm going to make sure that's selected. Then I'm going to scroll down until I see minus 0.10 or the closest to it. So right here, I do have minus 0.10, which is the 10 delta. I'm going to sell this. Like I mentioned, we target between $20 to $40. Right now, it's about 41, so that's right in our range. And so you can see with that, you can see I have a max profit of $2,062. I have a potential win rate of 93%, and if I move my face, a buying power about 5,500. So this trade only takes about $6,000 to put on. So let's do the math here, okay? If I have a $2,060 profit target, that means that if I'm taking profit at 25%, I'm going to end up with a net profit on this trade, if it's a winner, of about $500. So that's great. That means, remember, about 2 weeks. So every 2 weeks, I'll make about $500 on this trade. Which is a really great setup. I'll make about 500. Now let's divide that to see how much money I'm making based on the amount of money I'm putting up. This is called my return on buying power, or my return on capital. So you can see here, I have to put up about $5,500 to put this trade on. Let's just go 5,600 for easy math. That means that I'm going to make a 9% return on my money in a matter of 2 weeks, right? You can see there, based on my 25% take profit, I'm going to make a 9% return. 2 weeks, 9%. Tell me what bank would give you a 9% return in 2 weeks. So basically every month, if you do 2 trades a month, because it's every 2 weeks, you'll be making about an 18% return on your money, which is insane, which is really great. And so again, now it will make sense. If you're like Austin, that makes sense now, right? If we can only use 30% of our account, it now makes sense how I can actually make a decent profit, right? If I have a 100K account, I should be trading no more with 30K. But if I'm making like 10% returns a month off this amount that I have invested, that means I'm making $3,000 return, but only using 30% of my account. So that means I'm making a 3% return on my overall account. A 3% return every month times 12, that's a 36% return a year. You've just beat the market by 3 to 4 times. Again, and you're doing so with a very high win rate as well, about 99, depending on how you structure the trade. Remember, that's not guaranteed. That's what we see in back tests, but still you can see how much profit you can generate from this. And so again, we can do the same thing if we're doing it on SPY or SPX. The only difference is the buying power won't be as favorable. So if we do this on SPY, we can go down here and find 120. You can see we have the 130 one here. So click on 130. We'll make sure we pick the 10 delta. So right here, look for minus 0.10, which is right here, 515. And you can see here, max profit, $400. So again, 400 basically, and then we multiply that by 0.25. That means our return on this trade with a 25% return is about a $100 profit. But if we look at the buying power, it's the same as ZS. It's $5,000. So this is why futures give you so much more leverage, right? I put up 5,000 with futures and I get to make 500. Here I put up 5,000 on stock and I get to make 100. So this is why, if you can, use futures options if you have the account that allows it. That's why I always do these on futures options, because the return that I get is just amazing. But regardless, if you don't have access to futures, doing this on stock will still yield a great return as well. Again, you're making a $100 return off of 5,000. So that's still a 2% return in a matter of 2 weeks, which again is still really good for your account. So that's how we pick the strike prices and understand what happens. Now, let's talk about risk. Remember, I said that we need to make sure that we're managing risk correctly. And so the two things are market crashes and volatility will be some of the biggest things here. So let's address each one. Number one, let's look at a market crash risk, okay? So no matter what charting platform you use, whether it's TradingView like I'm using here, or you're using your broker site, go to the chart and go to the indicator section. There's an indicator that all platforms have called the Bollinger Band, Bollinger, Bollinger Band. Click on that. Now, Most people will use it like this, and almost nobody has adjusted the settings like this before, so let me show you how to do this. If you hover over the indicator and go to the settings of it, change the length. By default, it's 20. Change it to 200. Add an extra 0 and click Save. What this does is this moves this middle blue line, which is typically a 20-day moving average, to a 200-day moving average. So this helps me see the average range for a long-term trading or long-term asset. And so if we're looking at this, shows where the market should be trading. The market should be trading within this range. This means if it trades outside of this range, it's likely to pull back into it. If it trades to the upside, it's likely to pull back down. If it trades to the downside, it's likely to push back into the range. That's what this shows. You can see here, broke out below, pushed back up, broke down below, pushed back up, broke out above, pulled down, broke out above, pulled down, above, pulled down. And so you might be seeing where I'm going with this, okay? If that's what it shows, then that means when the market breaks to the top side, what should I be doing? I should be offloading some of my positions. I should be decreasing my trade size, right? So if I normally do 4 trades open at a time, I should move down to 2, maybe 1 trade. If I feel very risky, then I might even close out all my trades entirely. And so when the market is breaking this top range, you can reduce your risk massively by just offloading some positions, clearing half of them, or maybe getting out of all of them. You can see here, it would have helped you with 2020. It would have got you out here before it crashed down. You would have been able to save a lot of your losses and then been able to, hey, look, it's recovering, and then re-enter, which is actually what a lot of my members and I did back in this time. It was shorted here, and then we bought here. And again, a lot of my long-term investments were bought here, and now they've been doing great because of this. And this is all using a free indicator that I recommend you guys should be using to help you understand where is the market at risk of turning around, where is the market at risk of adjusting quickly. And so that's how I use it to size my options trading and help with market crash risk. Now, when we're dealing with volatility risk, we're looking at VIX, which is the volatility index, okay? You can see here, I drew it out before. Let me remove my draw length and do this again, okay? So we can remove this indicator if we don't need it on VIX. But when VIX is low, again, you can see here when VIX is trading around these prices, let's say below 17, below this area, the risk of it moving higher is a lot higher than if it were trading up here, right? If it's trading up here, the risk of it moving higher, you can see, is quite low. So if it's up here, we're probably going to go down. If it's down here, we're probably going to go up. As option sellers, we want VIX to go down. If VIX goes down, we make money faster and quicker. If VIX goes up, we lose money, okay? And so when VIX is higher, we want to be in more positions because we have a better chance of making money. When VIX is lower, we want to be in less positions. So remember how I said the 30% rule, no more than 30% of our account should be in trades? If you really want to get rid of a lot of risk, then change your sizing based on VIX. If VIX is up here in the high 40s, then use your whole 30%. And if VIX is down here, the lowest where you have the most risk, make it 15%, okay? So that way you can actually size accordingly, size properly, so that if something happens, you're not losing money on a ton of trades, just a few trades. And then as the market goes up, you can then get a better fill and then take advantage of it on the way down. Anyways, that's how we adjust risk. Because if you want to do this for retirement, or you want to make this consistently, then you need to understand risk. And so market crash risk and VIX risk are the 2 biggest risks. And these are 2 ways that I offset them that my team has absolutely loved and has been doing for a while now. So that's how we do that. So let's go back to the slides because we covered the whiteboard and the broker and the risk. Okay. So now for a cherry on top, I want to show you how to automate this strategy, right? Because if you're trying to do this for retirement, not only do you want to generate monthly income on a consistent basis with very little risk, which I just showed you, and you can go do by yourself. You can literally take everything you've learned here and go do it. But you probably want your time back too. You probably don't want to be stuck to a chart analyzing where is VIX, where's the risk levels in the market, what strike prices should I pick, be afraid of picking the wrong price or fat fingering it so that you mess up the order. Instead, if you want it done perfectly every time, then you can check out automation, which is simple. So again, let's turn the put selling strategy into a bot so that we can generate passive hands-free income. So step 1 is we need to sign up for an automation software, okay? Here are some of the most popular ones. We have Option Alpha, which again allows for options automation, but they do not allow for put selling. So you would have to turn it into a put credit spread or something. So it might not be the best there. Trade Steward, they do options automation and they do allow put selling, which is awesome, but they technically only support one broker right now. They don't have great support and they don't offer paper trading. So if you wanted to test it out first, you wouldn't be able to. They also, like I mentioned, don't support futures options. So it'd be hard to get that great leverage. Now, the Options Auto Trader will support options automation. It will allow put selling. It will allow it on stock options and futures options. So if you want to see that massive 9% return, then you can do that on futures options. It has great support that responds in less than 3 hours. It supports over 4 different brokers and it offers paper trading. Now you may be wondering, why am I saying all this and this looks amazing? Yes, I am biased. I'm the one who built the Options Auto Trader, but still, when you do a feature comparison and just see how our members are doing so well, it's a no-brainer to check out the Options Auto Trader. All right, cool. So once you've used or signed up for an options automation software like the Options Auto Trader, then you need to connect your broker account. Okay, so the Options Auto Trader supports the most brokers out of all these automation tools. So we support Schwab, Tasty TradeStation, and Tradier. So again, remember the broker profits that I showed you earlier and my broker? I placed none of those trades. They were all done through the Options Auto Trader, which is awesome. So if you're one of these brokers, you can plug them in and get started. Now, step number 3 is, now that we have the software, now that we've connected our broker, now we need to actually take the rules and build our first bot. And so this is actually more simple than you might think, okay? You just take the rules that I gave you in this video and you plug them in, and that's all that's done. And after you plug them in, you just sit back and you let your bot generate monthly income for you, which you can see here. One of my other accounts has already made me $7,500 so far this year, which is pretty great. So do you want to see a quick 5-minute demo so you can see how simple this is? Okay, sweet. So if we dive in here, you can see here's one of my accounts. What we'll do is we'll just plug in exactly what we just did. So again, we'll say create an auto trader, which means we're creating our own bot. Again, since we have all the rules for this bot, we'll just click on create an auto trader. So I'll click on this. Next, I pick the strategy. This is a put selling strategy, which is also known as a naked put. So naked put, just a single put. Next, like I mentioned, my favorite asset is ES or MES. For this example, I'll do an ES one because I can do futures options on this platform. Remember, I said I like my expiration to be 120 days out. You can set this to whatever you want, but I set mine to 120. And I set my delta to 10. So I'm selling, -1 means I'm selling a contract at the 10 delta. So just like that, exactly as I go in the broker and do it, I do this here. Perfect. Next, I say, how often do I want this bot to enter the trade that I just set up? And so like I mentioned, these trades typically work best at once a week, depending on your account size. So you can see right here, I can do once a week and set it up just like that. Now, how do I want the trade to get managed? Like I said, I do a 25% take profit. I don't do a stop loss. And I do 21 days early management. So when there's 21 days left, it'll close out the trade. Just like that, plug in those details, and it will manage it for me just like that. Moving on. Next, it asking me how much money should the bot use. And so like I mentioned, for the average trade, it's going to take about $6,000 with ES. So I put in $6,000 to ensure that at least one trade goes through. Now, remember how I said the biggest risk in this is the market crash risk and the volatility risk? With just 2 simple buttons, you can enable that risk, or I should say mitigate that risk. And if we enable this VIX-based buying power, our buying power for this bot will automatically change based on where VIX is. Is here, if I enable this, when VIX is higher, 40 plus, it'll use the whole $6,000. When VIX is lower, which is I have more risk, it'll use less money. So it'll automatically size my positions based on the risk in the market. So I no longer have to look at VIX to understand that. I can just enable this and help mitigate a lot of volatility risk. Now, the market crash safeguard, remember how I said, hey, we can use the Bollinger Band to give us an indication of when the market might pull back. If I enable this, it does exactly that. It looks at the Bollinger Band and assesses, is the market at a chance of crashing? AKA, is it outside of those ranges? And if it is, it'll start to offload your positions so that you don't have risk at that time. And so just like that, 2 buttons you enable, and you're able to reduce a ton of risk. Just like that, you can see here how the bot is set up. It explains the rules for you. You can save the auto trader and set it live. Just like that, the bot will follow your rules, place the trade in the broker, manage the trade for you, and do everything for you and give you updates along the way. And so again, that's the Options Auto Trader, and that's how cool it is, or at least I think it's cool. Isn't the Options Auto Trader awesome? I hope you think how awesome it is now, whether doing it for put selling or some other strategy. And if so, you can get started now with a 30-day test drive in the description down below, or go to www.optionsautotrader.com/get started now. Go to www.optionsautotrader.com, get started now to do your 30-day test drive. Whether you do it or not, it doesn't matter. I've given you all the rules, all the tools that you need to do it yourself on this video. So go implement it, go make money, see how this works. And then if you want to use automation, you can. Anyways, guys, hope you enjoyed this video, and I'll see you in the next one.